Good morning, everyone, and welcome to our audience wherever you might be around the world. Today I'm in Dubai, which is why I'm saying good morning. But I'd also like to welcome today Kieron Kader, who is with Alquity, which is a fund manager we've been using for quite a long time. And we're delighted to welcome today Kieron, who has extensive experience in working with money, managing emerging markets. And today we are going to be talking about emerging markets and whether, with the changes that are going on in the world, this is an interesting sector for, investors to be looking at the moment. So, Kieron, welcome to our podcast, and thank you very much for putting aside some time today to talk to our audience.
Of course, thank you very much for having us, James.
You're very welcome. So, if we could maybe start the podcast by asking you a little bit about your experience as an individual and also as a company in terms of managing emerging market funds. So, can you perhaps highlight a little bit about your experience and also the experience that Alquity have and where their strengths are with regard to managing emerging market money?
Yes, of course. So, thank you for the introduction and thank you for the invitation. My name is Kieron, and I am the associate portfolio manager here at Alquity. I, with my colleagues, manage three funds. That's the Future World Fund, which is our emerging markets fund, an Asia ex-Japan fund, and also a standalone dedicated India fund. Now, just a little bit about myself. I began my investment career almost 10 years ago now. I started at one of the largest pension funds in the UK and then moved to Alquity about 5 years ago. So overall, I've been investing and managing emerging markets and frontiers for the last 7 or so years. As mentioned, I work for Alquity, and this company was founded in 2010. And its origins began with an Africa fund and then soon broadened out to emerging markets and an Asia fund, as well as our India fund. Alquity introduced what we believe is a novel investment approach. So we've always targeted strong financial returns for our investors, but also targeting alongside that significant social and environmental impact. And this mission has really been fueled by operating the traditional asset management business, Alquity, alongside our own foundation. That's the Alquity Transforming Lives Foundation, which receives 10% of all of our revenues. And that's used to fund high impact projects in the countries that we invest in. And so this is obviously quite a different approach to investment management. And we think this commitment shapes every decision that we take. And it proves that responsible investing and profitability can coexist.
Okay, Kieron. Well, look, thanks a lot for that. So let's start delving now a little bit more into emerging markets and where the opportunities are for investors here. So perhaps you could highlight, based on the experience that you guys have, what do you consider to be the main emerging markets, or let's put it in a way, the most interesting emerging markets at the moment to be investing into?
Sure. So in terms of what the sort of main emerging markets would be, I would say that there are a few particularly large ones, the likes of China, India, Brazil, Korea, and Taiwan. But there are also a plethora of smaller countries with great opportunities that we can go into in more depth. I just wanted to perhaps preface this with the fact that though we call emerging markets a separate asset class, or we sort of bucket it all into one group, within emerging markets, there's more than 20 countries, each with their own unique characteristics, their own opportunities, as well as their own risks. So it's important to remember that there's a lot of different types of countries within the emerging markets. And we think that makes emerging markets a really exciting place to be investing across all sort of time horizons. Now, in terms of which countries look most attractive from an investment perspective, I would say there's a few, and we would certainly segment them into, let's say, 2 broad categories. The ones that are structural in nature and the ones that are cyclical in nature. Some of the best structural stories in emerging markets, to name a few, would be things like India, Indonesia, Saudi, and Vietnam. These countries boast really impressive demographics. They're witnessing rapid economic growth. They're facing rising productivity and have conducive business environments. It's very easy for businesses to operate. And that makes them prime candidates for long-term investment. And I'm very happy to go into any one of those in more depth. The other bucket is perhaps those that are more cyclical in nature, i.e. the performance of those markets very much depends on the economic cycle, where they are in the economic cycle. And we can say that places like Brazil are very likely to be poised for a strong upturn, having had a very difficult period in the last 18 months as a result of rapidly rising interest rates. In fact, the central bank had to hike by almost 12%. Now that the central bank has started to ease or normalize interest rates, that's a positive sign for both economy and the markets. And there are smaller countries such as Thailand, which we believe are poised to benefit from the continued recovery in tourism. And that's obviously a major part of their economy. So that would be just a very brief overview of the countries that we think are great investment opportunities that we see today.
Okay, great. Well, look, thanks for that, Kieron. And as you said, we can dig into some of the perhaps your preferred markets later on the call. But you also mentioned in your introduction that you're also involved with frontier markets, or you had experience in frontier markets as well. So is that something that Alquity is involved in? And could you perhaps explain what is the difference between emerging markets and frontier markets for our audience?
Yes, absolutely. So yes, Alquity does invest in the frontier markets. In fact, our investment mandate is largely unconstrained, so it allows us to explore the very best ideas across both emerging and frontier markets. We have allocations to countries such as Vietnam and Bangladesh. Both, we believe, present really unique and exciting investment opportunities. There's some key differences between emerging and frontiers, and they're really differentiated by a few characteristics. The first would be the levels of economic development. It will be differentiated by market accessibility, as well as their investment risk profiles. So broadly speaking, emerging markets will typically have more established financial markets, larger economic scale, and higher liquidity. And that would include countries like China, India, Brazil, as mentioned, but there's also a bunch of smaller countries such as Thailand, the Philippines, Peru, and many, many more. On the other hand, frontier markets are at a much earlier stage of their economic development compared to emerging markets. These markets typically have lower market capitalization, i.e. they're smaller. They tend to have less liquidity and are generally considered less efficient. They offer high growth potential, and that's bolstered by things like strong demographics, or it could be significant room for economic reform and development. But as a whole, frontier markets are generally going to be considered a little bit riskier than emerging markets.
Okay, thanks for that, Kieron, as well. I think it would also be probably fair to say that over the last 5 years or so, emerging markets probably, from a return perspective, have not performed as well as, let's say, the US. And emerging markets tend to go through these cycles. With regard to the current economic background, where we're potentially looking at reduced interest rates reducing maybe towards the middle or end of this year in the US, how do you see the current economic background with regard to emerging markets? Do you think, over the next 3-5 years or whatever, we're like to see a pickup in the performance of these markets so that investors who are looking to get into emerging markets or who are currently are already investing in emerging markets? So we like to see a pickup in returns now because of what's going on in the world with regard to from the economic perspective and potentially reduced interest rates in the US?
Yes, so I think that's a very fair question, both in terms of the relative returns from EM versus the US, and also the outlook for interest rates. So I'll begin with the interest rate environment, and I think you're quite right in terms of the global interest rate environment is looking much better, and generally speaking, yes, lower interest rates are better for emerging markets, and yes, it does appear that we have approached or have reached already the peak of the interest rate cycle in developed markets. Now, this is obviously good because as the Federal Reserve in the US begins to lower interest rates, that typically results in capital flows towards higher yielding emerging markets, and that supports their currencies and the financial markets. So that is a very key part of the story, and where we are in terms of the interest rate cycle. I think maybe broadening out the question a little bit in terms of overall global economics. I think it's fair to say that many economists predicted incorrectly that a recession would happen last year. And the data that we see today suggests that global economic growth actually looks okay. Now, that might continue to decelerate a bit, but indicators suggest that the US particularly have managed to achieve its so-called soft landing, i.e. controlling inflation by raising rates, but without triggering the recession. And this scenario is actually also really beneficial for emerging markets, especially for countries that are major exporters of commodities, products, and services, as global demand remains resilient. And that again is good for emerging markets. I also wanted to just highlight on the question about relative returns. So you're right, I think the relative returns for emerging markets has been somewhat disappointing over the last few years. It is important to highlight, though, that within emerging markets, there are obviously many different countries, and some of those countries have actually performed either in line or exceeded the returns of that in the US. Now, as an index, this has been a relatively poor performer in the last few years, particularly because of China. And China was around 35% of the index. And because of its underperformance in the last 2 or so years, that's really dragged down the rest of the index. It's obviously a big part of the whole emerging market index. Now, there are other countries such as India. India has done very, very well for investors over the last 3 or 4 years. And that has its own idiosyncratic story. It has its own structural story. And that we believe will continue. And so I think within emerging markets, it's always important to remember that we need to find the countries that will provide the best fundamentals and the best returns for our investors. This, I think, is a very actually key argument against that of passive investing, as opposed to what we do, which is active management.
Well, Kieron, I think that's very helpful for the audience, and we've sort of touched on this a bit as well, and you've just talked about it now. But in terms of, you know, what you're doing with your emerging market, or I think you call it your future world fund now, how would you say that would differentiate from being a passive investor into emerging markets? And where, you know, obviously, can you maybe talk a little bit about some of the ideas that you have for that fund, which might be of interest to our listeners, and give them an indication of potentially why you know, they would consider an active fund manager as opposed to just investing in an emerging market index? Because I think, you know, one of the things you've just highlighted is that because of the size of China, if you were to go into an emerging market index, that would probably mean that 30 to 40% of your money would be invested in China, whether you liked it or not. And that would be because, you know, that's the weighting of the index. So how does your fund differ from, you know, as you say, being a passive investor? Can you sort of talk to us about specifics, like, so how much would you have as a percentage, you know, in China, for instance, in the emerging market fund that you have, as opposed to, let's say, someone who was a passive investor? And maybe you can also highlight, you know, emerging markets that you have overexposure to, because, you know, you like the demographics, you like, you know, the story that are in those countries. And perhaps we could also touch on, in your emerging market, would you also have frontier markets? Would you include sort of companies in frontier markets in that fund as well? So a lot of things for you to think about there, but if you could give us your perspective on that, I think that would be very interesting for the audience.
Yes, absolutely. So I'll try and tackle it. But if I do miss anything, please just remind me, and I'll be glad to approach that as well. Let me just answer the question in terms of active management versus passive investing. So I think you quite rightly said that passive investing, it's designed to mechanically follow the benchmark, and therefore reflects past performance, i.e., what's already happened. And so in the case of China, in previous years, yes, it was a stellar historical performer. And that's how it gained that index weight of around 35%. However, as a result of its underperformance since 2021, that index weight has moved all the way down to 26%. And that's a trend that may well continue. And as active managers like ourselves, we're able to foresee and adjust to those trends, meaning that we can mitigate risks that might significantly affect overall index performance. So it's also, active management is not just about finding great ideas, it's also about managing risk and downside. I think another key argument against passive investing is that the index contains all sorts of companies. When you buy an index or an ETF, you are accessing all of those companies. Now, indeed, some of those companies are going to be very strong and very high quality. However, others, in our view, are going to be completely uninvestable, and they pose outsized risks. So I think a clear example of this is that Alquity has never invested in the company Alibaba. Alibaba is a tech company based in China. And at one point, this was the largest company in the emerging market index, with a weighting of close to 9.5, or around about 9%. So a significant part of the index. Now, we never invested in this company for a multitude of reasons, mainly governance risks, which we saw with the founder Jack Ma. Now, Alibaba has actually declined more than 75% from peak to trough, and now represents just 2% of the index, from 9% just a few years ago. So I think overall, I believe that is a compelling case for a proactive, active management style in emerging markets. And using a forward-looking strategy is really quite essential for navigating the overall complexities of emerging market investments. Now, going forwards, and sort of expanding on this forward-looking idea, we try to identify the best stories in emerging markets, whether they're cyclical or structural. And I think you asked, what are the sort of interesting ideas and countries that we're accessing at the moment? And I think one of the key countries to be thinking about is India. Now, India has all of the positive demographics that we know about. It has the rapid economic growth, rising productivity. It also has a number of structural growth themes within the country. And one of them is that of the formalization of the economy. So that roughly looks like the shift from informal companies to formal companies. Informal companies we would roughly define as the sort of mom and pop stores or hole in the wall stores, or just general sort of street vendors. Now, as Indians move into the middle class, they're demanding better quality products and better quality services. And this is a really powerful theme because literally millions of Indians move into this middle class every single year. And now we aim to access this theme, and it flows through the majority of our portfolio. But we have a number of names that really play to this theme. And just to name perhaps one is Lemon Tree Hotels, which is a hotel operator. And it's capitalized on these trends by building out an extremely impressive class of hotels that are high quality, hygienic, great value for money, and as a result has seen its occupancies and room rates increase dramatically over recent years, and we believe that continues for many years to come. Perhaps another theme to touch on is made in India, the theme of making or manufacturing within India. Now, India has a number of solid advantages versus other manufacturing countries. Things like its huge labor force, its very low cost labor force, and the high absolute numbers of skilled talent. Now, clearly that's going to be very, very positive for any manufacturing industry. But to take it one step further, the government has now implemented a series of incentive schemes for foreign and domestic companies to set up base and expand in India. So this really benefits manufacturing companies in the country. One that we'd like to highlight is Dixon Technologies. This is a manufacturer of consumer electronics. It manufactures on behalf of global giants like Samsung, like Philips, Motorola. And it's actually seen its revenues grow almost sixfold in the last 5 years. So again, this is clearly a very, very powerful theme. And we're very much targeting this forward-looking approach to emerging markets. We're interested in the future. We're not interested in what's already happened. And I think you also asked a little bit about frontiers. And one of our preferred frontier markets is Vietnam. And for us, this is a really exciting opportunity. It has all of the features that we've sort of mentioned in terms of a young and fast-growing population, many moving into the middle class. And again, we're trying to play to a similar formalization theme here in Vietnam. So we own a company called FPT Retail, and this is one of the largest electronic store operators, as well as one of the largest chains of modern pharmacies. Now, I think the case for FPT Retail is really clear when we look at it through the lens of formalization. Clearly, there's a need and demand for medicines and pharmaceutical products from a trusted modern brand, as opposed to the traditional mom and pop hole in the wall type store. And the company has aspirations to be something like Boots in the UK, which, as we know, has a phenomenal franchise. And the store growth for the company has been rapid over recent years. They've added hundreds of stores, and we think that pace continues for many years to come. So I think that, again, highlights some of the structural opportunities that we see in both emerging and frontiers.
Okay, excellent. Look, Kieron, thanks for that. And perhaps again, in terms of what we were talking about with benchmarks, can you give us some idea as to how you've changed your allocation, with regard to India against the benchmark? So you highlighted that you've obviously reduced your exposure to China, and actually as part of the index now, I think you said that was around 26%. So if you were investing in a passive fund in India, what would be the percentage that you would be holding in India against, say, what you would be currently holding as an active manager in India at this moment in time?
So yes, in terms of the China weighting, yes, you're right, that has come down to 26%. And if you were looking at a index for emerging markets, that would include a 16 or so % allocation to India. We're roughly around about that or slightly higher, depending on how you calculate the weightings. So one of the aspects that we consider when looking at portfolio construction is how the beta of portfolio or countries will move. So for example, if we have a very high beta Indian stocks, those will move faster than the Indian index on average. So typically we'll have round about a neutral or slightly overweight position to India, depending on the beta of the portfolio. And as you mentioned, we do have our dedicated India fund, which we've been operating for more than 10 years now. And that has direct exposure to all of the themes that we've been discussing today, if you didn't want the exposure to the rest of emerging markets, such as China.
Okay, well, look, thanks a lot for that, Kieron. I mean, one of the other things, obviously, is that investing in emerging markets must be quite complex, and it must be sometimes difficult to get to grips with the markets that you invest in and the opportunities that there are there. Can you tell us a little bit about the process that Alquity have when it comes to stock picking in these kind of countries, as it were? What is it that you do? I mean, for instance, do you do sort of road trips to these countries and go and actually individually meet companies? And what else do you do when you're sort of traveling around the world, as it were, talking to these companies? Can you sort of explain to the audience about how your decision process is made when investing into new markets or new companies?
Yeah, of course. So um, the very first thing that we'll do is we'll look at the whole investable universe. Now, for us, that's not just the emerging markets index. That's for us, it's the whole emerging markets universe, which has something north of 10,000 companies. We'll have a filtration process that helps us get down to a more manageable number. So we'll filter out for things like market cap, for free float and other factors such as ESG. We'll heavily incorporate that into our screening process. And then, yes, as you quite rightly mentioned, in terms of once we've found some of these ideas, we will absolutely go out to meet the companies. We will assess the fundamentals, and we also do our own evaluation models. So we always want to be sure that we're paying a good price for a good company. Fundamentally, we're trying to find things that are undervalued and that over time, that will converge to their fair value, as we call it. Over time, it will deliver the returns that we think are reasonable.
Okay, well, look, that's great. And just to give clients or the audience an example, in your emerging markets fund, roughly how many companies would you be holding in that fund?
Right. So it can depend, depending on where we see the opportunities. So currently we have approximately 60 holdings, and so I think that when you compare it to an index that has probably around 1,200 names, 60 is a relatively concentrated portfolio, and that's also invested across quite a few countries. I think we invest in around 20 countries. So that does give you some broad exposure, but also concentration on an individual name basis. And that really reflects our conviction in the companies that we hold in the portfolio.
Okay, and generally, would you say that you're long-term investors? So if you buy into a company, would be the goal to hold it for a year or a few years? Or how do you sort of target in terms of the return that you're going to try and achieve from the individual stocks that you buy?
Sure. So we would class ourselves as long-term investors. And when we invest in something, we aim to have a holding period of at least 3 years. And oftentimes it's much, much longer than that. Now, of course, this isn't something that we are absolutely wedded to. If, for example, the investment case had changed, or if the stock price had done extremely, extremely well, and we were worried that it was perhaps short-term overvalued, then yes, we do have the flexibility to reduce or exit a position earlier than that 3-year period. But for the most part, I would say we definitely have a long-term horizon. And that's because we want to, sometimes takes time for the market to appreciate, particularly the smaller companies that we invest in. It takes the market some time to appreciate just how good a company is. And therefore, it typically takes maybe 2 or 3 years to play out.
Okay, well, look, thanks for that, Kieron. I think that gives our audience an interesting perspective because, as you say, I think when you're in investing in emerging markets, it does sometimes take patience because you can find some really good companies in a particular market, whether it be somewhere like Vietnam or India, which you've mentioned. And there may be other circumstances that prevent that stock from appreciating initially. And as you said, it may take changes in interest rates or something else going on in the world for that market to then, or that company to get its true potential. So I think it's interesting, for investors to understand that you do need perhaps more patience in emerging market funds sometimes than others. But ultimately, this is probably where the growth is in the world. So I know you're now based down in Australia and I'm in Asia, and I travel a lot around places like Vietnam, which we've discussed, and the Philippines and Indonesia, and the growth that's going on in those markets is staggering. And I think, as you said, if you can pick the right companies, clearly there are some sizable opportunities there. And I think what you've said in terms of active fund management is really valid as well for investors. I mean, not all markets are created equally. So rather than just go into all markets that there are, if you've got someone who can, give you direction to not only find the best companies, but the best areas to invest into, I think that's definitely going to help investors as well. But Kieron, just before we go, as it were, is there anything that you'd like to sort of add before we sort of sign off? Is there anything else that you want to mention about Alquity, which will help our audience?
Yeah, sure. So I think, Alquity, as mentioned, we are active managers. And we believe we are differentiated, not just from the passive management that we've described, but we also feel that we are differentiated from other active managers. We believe that our approach and expertise distinctly sets us apart from the rest. So Alquity, the team, we boast over 40 years of combined experience, and we adopt a rather unique research methodology. So, as mentioned, we do go on the ground to do research, but unlike many others, we actually delve deeper into the less traveled towns or the less traveled regions to particularly find those small cap companies that are often ignored. I think it's fair to say that many peers would just stay at the five-star hotels in the capital cities, whereas we would go well beyond these conveniences to try unearth hidden investment opportunities. I think another perhaps key differentiator is that we do all of our ESG analysis in-house, so all of it is done by the investment team, and that allows us to seamlessly and fully integrate ESG into our investment process, and that's been done from day one, since inception of the funds. And again, that's very unique to us. And lastly, all of these things combined in terms of the deep fundamental research, the grassroots research, the ESG, we believe that this approach has been validated with regards to our long-term performance. We operate multiple award-winning funds, and notably our India fund actually ranks in the top decile versus peers over multiple horizons. So, all in all, I think we have a blend of deep experience, a differentiated type of research, ESG commitment, and alongside our foundation, which provides a very powerful social impact. I think all of those combined positions us as quite a compelling and differentiated opportunity for investors.
Excellent. Well, look, thank you very much for the summary, Kieron. Hopefully that'll be really interesting for the audience. I think it's important also that the people listening in today understand that probably the emerging market sector is going to come at the higher end risk scale, as it were. So this probably isn't a suitable asset class for everyone, but I would suggest that for people who want exposure to these exciting, dynamic new markets and have got a reasonable time frame in mind, I think historically, having an allocation to emerging markets makes a lot of sense. And as we've discussed on the call, if you can do that with an active fund manager, you're more likely to succeed than just going into a passive emerging market fund. So once again, I'd really like to thank you for your time today, Kieron, and also I'd like to thank the audience for listening in. Please get in touch with us if you've got any questions. otherwise I'll look forward to welcoming the audience again for our next podcast. But Kieron, once again, thank you very much for your time.
No, thank you very much for having us, James. Very glad to be part of this.